back, ladies and gentlemen. We now move on to the next standalone session titled Push for Digitization, the New Normal for the Insurance Ecosystem. And it's my pleasure to welcome and introduce Yashish Dahiya, co-founder and group CEO, PolicyBazaar.com. Yashish, over to you.
Thanks, Ivan. Thank you very much. So it's an interesting topic, push towards digitization. And of course, as you all know, with the 53 insurance companies and roughly 90% odd of insurance in the country sold either through agency or through banks, and largely insurance being a push product where somebody had to go knocking on someone's door to convince them that they needed insurance, whether it was an investment product or an insurance product. I think consumer engagement has grown, but in the last few months, what you have seen is there is no physical meeting between consumers and anyone. And so what that implies is pretty much all the insurance sold in the country has one way or the other been sold digitally. Now, of course, there is a huge amount of people involved in this still. There's a lot of physical agents, a lot of bank relationship managers who are reaching out to customers and making these transactions. But as we look at let me try and paint a picture of how I see the next 5 years evolving. You've had the first phase where there have been a few aggregators like us who have popularized digital research of insurance products and an interest in insurance products, wherein consumers have gotten up in the morning and said, okay, I want a health insurance or I want a life insurance, which is extremely essential for the country. We also have a few insurance players bringing out digital only offerings, which implies there is no agent, there is no intermediary, it's just direct to consumer. And then you have ecosystem plays which have been out there, whether it's the Amazon, whether it's the Paytm, whether it's a Flipkart, whether it's an Ola, whether it's an Uber. And this is not a new trend alone, because you have had travel portals. I remember when I used to run ebookers, we had a travel portal, and the travel portal used to sell a lot of travel insurance as a sort of tick box product. So if I was to break down insurance as a category, and let's get into the different product types, there is a large component which is which is held by the investment products. And then you have motor insurance, which is compulsory, motor, two-wheeler, and you. And the third element would be what you would call voluntary risk products, voluntary lifetime risk products. And these would be products that protect individuals against death, disease, disability, term insurance, health insurance, disability covers, personal accident covers. And then there would be a fourth, which you would say are attachment products. These are on the spur purchase products. You're buying a mobile phone, you want it insured for the next couple of years. So you buy some protection with it. You are buying a cycle, you're buying a computer, and you buy some protection with it, or some warranty with it, or some extended warranty with it. Now, I think today there's a huge move towards digitization that has happened on the voluntary risk products, because that is a product which is stemming from consumer demand. If the consumer does not demand it, then it cannot really be sold, because there isn't any return out of it, and it's not mandated. So it's not like the government is asking you that you must have this particular product, and hence it comes out of consumers' free will, and that free will is largely expressed on the internet. So health insurance, life insurance, etc., have moved down the digital path quite a bit. You do have, on the other hand, the investment products, which almost do not have any consumer pull. They are largely sold by the agency and by the banks. And here the relationships matter. What relationship the person. So here the kind of digitization that is happening is back-end digitization, where you almost have the agent having all the tools and technologies to essentially converse with the consumer over a WhatsApp or over a phone call or over a video call, and the insurance company providing a technology platform to consummate the transaction. So it is all digital, but it is still relationship-based digital. Now, the third element, which is motor insurance, that has again moved significantly digital because it's a mandatory product. Uh, People have to purchase it. There are two things that happen here. One, you've got the manufacturers, the auto manufacturers, who have a large share in this market, roughly 50 to 60%. And for the first couple of years, most of them would sell the products themselves to the consumer. So in a way, it is like an attachment product. You're buying a car, you have to buy an insurance. So, I'm the car seller, so I will control the transaction, just like a mobile phone seller will control the transaction of, the or a ride company will control the transaction of the ride hailing platform. And but then, after a couple of years, people do not have as strong an engagement with the manufacturers, garages, etc. And so they do look out, and that is where a lot of digital transactions happen. I would say in that area, roughly 25% of all motor insurance is now digital. And then the fourth element, which is attachment products. This is largely a digital sale. This is largely happening. So, when you're buying an Uber or an Ola, or whether you are taking a flight through Make My Trip, or whether you're buying a mobile phone through Amazon or through Flipkart, or you are doing something else, it is an attachment product, and that does happen. Now, what has not happened in India is what you would call large microtransactions, which large number of microtransactions happening from bottom of the pyramid. And that is both I would say, yes, there is something negative about it, but there's also a blessing in disguise. Because if you, on a global scale, go and look at most of these products, whether attachment products or these micro insurance products, they typically have extremely low claims ratios. Now, what does that mean? That means so in insurance, you've got two kinds of products, right? Consumer products and distribution products. Distribution products are products which are built for the distributor, which means they have high margins and they have low consumer benefit. But because the distributor holds the relationship, he would be able to get the consumer to purchase a certain number of those products or a certain percentage. So, when I was running, for example, ebookers, we would sell travel insurance. It was a distributor-centric product. In the sense, the distributor would have very high margins, but because you were on ebookers and you were buying a flight, you would get an option to insure it, and the insurance cost would be a small cost compared to the cost of the flight, and you would tick box it, and you would tick it about 18% of the time. And if the price changed a lot, it's not like your 18% is going to become 50%. And if the price became too expensive, the 18% is not dropping down either. So that is a standard distributor product. In such products, the claims ratios will be 10, 15%, 20% at most. So the claims ratio signifies what the consumer gets. The distributor commission signifies what the distributor gets, right? And this would be true of most attachment products. It would not be true of either motor insurance or health insurance or life insurance, because all three tend to be consumer-centric products. These are where the consumer starts to purchase them. And in these situations, the distributor margins will be relatively lower and the consumer will get most of the benefit. So you will typically have claims ratios of 70% to 90% in these products. And the distributor commission will be 10, 15%. That's just a broad lay of the land of how insurance works. And the investment products can be anything. They can be consumer-centric, they can be distributor-centric. But I think longer term, it becomes very hard for the insurance industry to compete with mutual funds and fixed deposits, which tend to be a little more consumer-centric in the broad scheme of things compared to insurance investment products. And so that becomes a challenge. However, these products also are a bedrock for the economy, in the sense they are the ones that provide the government with long-term investment. And so it is something that the government obviously desires and would always promote preferentially over mutual funds or fixed deposits from a taxation perspective. And thus, from the tax benefit perspective, some of these products do make sense. And a lot of them actually increasingly make sense because with the tax benefits that are provided, especially around 1010D, etc. They tend to be good. Now that's broadly, I've kind of been all over the place, but I've sort of given you a lay of the land of insurance. In the next few years, what you will see is very high growth in voluntary risk, because that is an area where the middle class of India has no protection whatsoever. Health insurance, life insurance. Uh, we've seen a surge in demand across the sector uh, during COVID for these products. However, one has to understand that COVID was only 11% of all claims made during the COVID phase. So even today, only 11% of claims are coming from COVID because of COVID. Remaining 89% of claims, and a claim is only made when somebody spends 24 hours in hospital. So it's a serious enough disease. So 89% of claims are coming for non-COVID diseases. And I think somewhere I read this article which said, do non-COVID lives not matter? I think in our focus on COVID and our focus on the current pandemic, we somehow seem to have put so much resource behind this particular disease that the medical services, the insurance services, the consumer focus is not as highly on some of the bigger diseases that are out there. And it's somewhere unfair to those patients, because those patients. So I kind of made my point, and the consumer also needs to think a lot more about those. So I think fundamentally, health insurance, life insurance will keep growing with or without COVID, and will largely grow digitally, because, as I said, they're consumer centric. What you will typically find is consumer centric products will move digital first. Obviously, digital centric products, distributor centric products can move digital only where the distributor holds a very strong digital position, right? Now, what you're going to see over the next 4 or 5 years is these attachment products really take off. So I think they're doing about 1,000 crores right now is the combined value of the attachment products, but this would take off further. As the e-commerce grows, this will also grow, and you will see increasing e-commerce, obviously, because physical distance is becoming significant. One of the things we are noticing is India has had a huge number of small retailers who have had, and this is not a phenomena we see as much in developing markets like Europe, etc. But it's an India-specific phenomena where you have a huge number of small mom and pop shop retailers, and these retailers are in a good position, or distributors, and these people are in a good position to distribute products as long as they get all the technology tools, benefits, etc., with them. So you're seeing a huge adoption in what you would call the point of sale kind of business, where an individual out there essentially becomes a point of sale and starts distributing anything, all kinds of financial products, all kinds of loans, credit cards, mutual funds, insurance, etc. And that can be a huge game changer. Now, what does this mean for the remaining part of the industry? I think uh, it is a game changer as far as agency is concerned, because an agent typically used to be a tied agent to one insurance company. With the POSP coming in, there is no reason why the agent would not essentially, through the POSP, tie up with 20 insurance companies through a platform. So you will see a lot of point of salesperson based platforms emerging. I think the challenge in these platforms, and this is as I get to the second part of the conversation, see, 70% of your cost is claims. 70 to 90% of your cost is claims. So eventually you need to make money by being better at claims management and by being able to assess risk better. And that's the obvious thing about insurance, that people need to assess risk better. Now, assessing risk better means you have to have the right information. The right information, fortunately or unfortunately, whichever way you want to look at it, comes on the digital platforms in a much more seamless manner, right? Today, we all know that when every time we open the computer, our identity is already known. So it's very easy to get information digitally through various tie-ups, etc. You can further corroborate the information. So, for example, when a person comes to our sister platform, Paisa Bazaar, he gets a credit score. We suddenly get to know a lot more about this individual. And then depending on whether a person has purchased a health insurance policy, a life insurance policy in the past, you get to know a lot more about the individual. So as you know a lot about the individual, you can start to make very fine guesses about the quality of risk. Well, very simple things. Is the person alive? Is the person well? Is the person employed? You can get a lot of these pieces of information, which you'd be surprised, but in the offline world, sometimes can cause significant problems. Now, the challenge for the POSP business, in my opinion, is that how would it mitigate uh, the risk factor, or the chance that a consumer and the physical agent put together, or the physical person put together, essentially fudge the information and give you information which is not true, and hence lead to significant bad risks. Because in the insurance industry, as you would imagine, if your fraud goes up by a few percentage points, it can pretty much destroy any business. But that's sort of some of the views that I have. I think I don't know what the format is. Are we going to have a question and answer, or do you just want me to kind of carry on saying a few more things about this?
We're over time on this right now. There are no questions that have come in yet. So in case you want to conclude with a few remarks, please go ahead.
So I think, in a way, I've already concluded, but what you would see is growth in POSP, growth in digital sales across the attachment sector, and you would see growth in the digital sales of health and term insurance. And all three will grow quite fast. I think in the next 5 to 10 years, more than half the industry would have moved digital. I know there are not a lot of other people saying so, but I see data more minutely than many do. And I believe about 15% of the industry has already moved digital. Of course, there's a large investment category, which will be much slower in adopting digital. And that has its own reasons. But yeah, that's what I would say. Thank you very much. Thanks, Iman.
Thank you. Thank you so much, Mr. Yashish Dahiya, co-founder and group CEO, PolicyBazaar.com. The new normal for the insurance ecosystem, push for digitization, was the session. Thank you for your insights. Thank you for your time. And we wish you and your organization the very best going forward.
Thank you.
With that, we move on to the second poll question for the day. As mentioned earlier, we would like you to participate in large numbers. Please minimize the player button so that you can view the poll question to the right of your screen. You will have 60 seconds to choose your option. Post the poll results being displayed, we will be back on the other side with the next live session.